Keels and Cargill's chain competitive financial performance analysis. Our group number 4. Our group table of content. Introduction, objective and methodology, profitability ratio, liquidity ratio, efficiency ratio, sell-in ratio, overall comparison summary, interpretation and implementation, recommendation, conclusion. Thank you. Introduction. Industry overview. Sri Lanka's fast-moving consumer goods and food retail sector plays a major role in the country's economy. It remains critical to the household sector. Cargill's Ceylon plc. Cargill's has retained shops, Cargill's Food City, FMCG manufacturing and restaurant chain including KFC and TGI Friday with over 500 retail outlets. Keel's Food City Production plc. As a subsidiary of John Keel's Holdings, Keel's Supermarket and Keel's Food Products are recognized leaders in processed meat manufacturing. Their products, sausage and cooked meat, which are sold together, their supermarket chain as well as various other retailers.
Our main objective is to evaluate and compare the financial strengths and weaknesses of Keels and Cargills using ratio analysis. We used secondary data from their 2023 to 2024 annual reports and calculate key financial ratios to make this comparison. When analyzing profitability ratios of Keels and Cargill's, Cargill's gross profit ratio, operating profit ratio, net profit ratio is greater than the Keels. That shows us Cargill's have a strong profitability than the Keels. Keels have a underperforming in profitability. Cargills have high return and good profit margin, but Keels have low return and weaker profit margin. Cargill's focused on wide retail networks and diversified operations, but Keels focused on processed foods, less diversified revenue streams. I think Cargill's good for efficient in converting revenue into profit, but Keels need to improve revenue generation. When analyzing liquidity ratios, Cargill's current ratio and the quick ratio is lesser than Keels. That shows us Cargills have lower liquidity than the Keels. Keels have more liquidity. Cargills have tight short-term financial flexibility, but Keels have strong ability to cover short-term liabilities. I think the reason of Cargill's lower liquidity is possibly high investment and debt and higher operational scale. Keels have a better cash and asset management and conservative financial approach. I think Cargills may face short-term cash flow risk, but Keels have a strong day-to-day financial stability.
Efficiency ratio evaluation. Efficiency ratio is the higher Cargill's PLC superior operational performance. With higher the inventory turnover and the debtor turnover, Cargill's manages stocks receivable more efficiently. It is also shorter collection payment period and the Cargill's is a better asset turnover ratio compared to Keels indicate the more efficient use assets of the debt generate revenue. I'll enough my presentation. I continue, my friend. Thank you very much.
Solvency ratio. When analyzing the financial ratio of a Cargill's PLC and the Keels PLC, we can observe the notable differences in their capital structure and the financial stability.
Cargills have a lower debt equity ratio compared with the keels, indicating the Cargills utilize less debt financing. Simplify the Cargill debt to total asset ratio, which is also lower than the keels, suggests the Cargills as a more convertible approaches asset financing. However, when it comes to interest coverage ratio, measure the company's stability interest obligation, Cargill stand stronger while of a lower ratio. Amplify the Cargill's better performance, interest expenses, higher greater financial health. Thank you very much. Thank you, my dear friend. I'm talk about here the explain about the expense ratio analysis, liquidity ratio analysis, and the efficiency ratio analysis. The analysis of the expenses ratio comparison. The analysis of the expense ratio relevance significant difference between Cargills and the Keels exhibited in the 19.7 compared to the Keels indicatedly potentially higher operating cost of insufficient. Conversely, keels have a higher distributional expenses. Cargill showing a strong enhances logistic of the distribution. The ROEE is Cargill's is the more favorable 20.68 and the 16.34 possibility to divisions, whether the kill shows very low run and the substantially better of utilization. The
Okay, let's see overall comparison summary in Cargill's and Cape's company. The first one is profitability. Cargill's lead with higher profit margin, showing better cost control and revenue generation. Cape's lags behind, possibly due to higher operational cost. The second one is liquidity. Kills outperforms with stronger current and quick patience, indicating better short-term financial health. Cargill was weaker liquidity, suggesting potential cash flow risk. The third one is efficiency. Cargill is more efficient in assets and inventory management, supporting its profitability. Kills show slower turnover and underutilization assets. The third one is efficiency. Car kills is more efficient in asset in and inventory management, the supporting its profitability. Kills shows slower turnover and underutilizes asset. The fourth one is solvency. Kills maintains a low debt, stable capital structure. Cargills use higher leverage, boosting returns but increasing financial risk. Okay, now I introduce what are the five types of accounting ratios. There are profitability ratio, liquidity ratio, solvency ratio, expenses ratio, and efficiency ratio. Okay, I'll give a brief explanation of the ratios now. The first one is profitability ratio. Uh, Evaluate the profitability or the financial result of the business. Profitability ratios helps assessing financial performance of businesses. The second one is a liquidity ratio. Liquidity ratio is evaluate short-term financial positions of businesses. These ratios help a firm to assess as to whether company will have to face short-term financial difficulties. The third one is efficiency ratios. Evaluate how efficiently a company utilizes its resources to generate revenue and profit.
In conclusion, a comparative financial analysis of Cargill's Ceylon PLC and Kale's Book Product PLC identified that both companies have a strong presence in Sri Lankan East FMCG and retail sectors, each with the respective strength. Cargill's portion is in extensive retailing base and market coverage, whereas skills benefit from the cost control and operational excellence, profitability, liquidity, solvency, and cost control in retail in financial ratios. Both companies indicate that both companies are financial sound but with different issues. Both companies need to give equal importance to making the operational excellent, cost control, and innovations to sustain growth and market leadership in the evolving retailing environment. Our presentation is over. Thank you.